Well, Treasurer Jim Chalmers has indicated inflation will remain a primary focus at the upcoming federal budget. Currently, monthly inflation sits at 3.4%. Ideally, it will drop again tomorrow when March Consumer Price Index figures are released, or at the very least, stay steady. To get an expert's opinion, let's bring in Judo Bank's Chief Economic Advisor, Warren Hogan. Warren, good to see you. Thank you for joining us. What are you forecasting for tomorrow? Good or bad news?
I think the numbers tomorrow should be okay. They're probably going to come in a little bit higher than those February monthly numbers of 3.4, probably more like 3.5 to 4, somewhere in that range. We're going to see inflation in the quarter just under 1%, which is an improvement on what we've been seeing in the last couple of years, but it's still too high. We need inflation down at around 2 to 3%, preferably closer to 2.5%. And tomorrow's number probably won't get us there and probably doesn't give us much insight into whether we're going to get there anytime soon either.
No, it doesn't appear that way. I've got to ask you, Warren, because the Treasurer is warning the drivers of revenue boosts in recent years, like high commodity prices, for example, aren't likely to repeat this year. Do you agree with that?
Look, the commodity price story has been positive, but it's not delivering big windfalls like it has in recent years, indeed at various times in our last 10 years or so. What it is that is delivering the revenue is income tax increases. Because of bracket creep and the strength of employment growth in the economy, the strong population growth we're seeing with people getting jobs, their income tax receipts have gone through the roof, literally, in the last few years and continue to. So whether that's repeated in the year ahead is a big question mark, and I think they probably won't plan on that being repeated. But of course, the Treasurer has got a track record of talking down both the global economy and our economy ahead of budget. The reality is the evidence we're seeing so far this year is that things are doing well. We're generating about 30,000 jobs a month, which is way more than our long-term average. Unemployment's back under 4%, and business conditions are pretty positive. So I think we're starting to see some green shoots of recovery after the slowdown last year, and that's somewhat problematic from an interest rate point of view.
Well, I mean, it's certainly positive news, but look, let's talk about interest rates because, of course, in the midst of all this, there are fears of more interest rate hikes, despite over 1 million Australians experiencing mortgage stress. Now, as it stands, Australia's interest rate, we know, is sitting at 4.35%. But Warren, does the RBA need to slash interest rates to try and kill inflation? I mean, how do you see this playing out now?
Well, there's certainly been a move away from this rate cut view that's emerged since sort of the summer months. It's overseas, there's less chance of seeing rate cuts in the US and in Europe. And I think here, because our interest rate's lower than in these countries overseas, if our economy does show some signs of recovery, that's going to put the RBA in a difficult position. So tomorrow's inflation numbers are important in the sense that they will give us insight into domestic inflation and whether or not they're on the right path with that. But I think you're right to point out that this story that the next move in rates is a cut is not a done deal by any stretch. And there is still a prominent risk that we may see further interest rate increases later in the year.
All right, well, we'll be watching it closely and getting your input as always. Warren Hogan, thank you so much for your time.